All right, well, we'll go ahead and get started here with some introductions. So first of all, I want to say thank you to everyone who's joining us today for the Q4 Playbook for Business Owners, key priorities for budgets, benefits, and business taxes. And at this time of year, we've got plenty to cover. So I'm very pleased that we have two outstanding panelists joining us for today. My name's Doug White, and my role here, other than to wear my favorite shirt, my Brady Renner shirt, is to introduce and present our two panelists. Our first panelist for today's program is Matt Brady, who is the president of Brady Renner CPAs. I think probably everybody here knows Matt or knows of Matt. He began his career at a leading regional public accounting firm, also worked on the client side of the table as the director of finance for a $11 million educational nonprofit, and later as controller and CFO for a building contractor. So he has both experience in public accounting and experience being a client of the public accounting profession, which is one of the reasons I think clients love working with Matt and his team. So welcome, Matt Brady.
Thank you, Doug.
And Matt is joined by his fellow colleague, Mike Kelly Jr. Mike is the vice president of Kelly Benefits, Kelly Financial Advisors, and Kelly Risk Management, the Kelly companies, collectively as they are known. And whereas Matt is a Towson alum coming from the Baltimore, north of Baltimore universe, Mike is a cum laude graduate of the School of Business at the University of South Carolina. So in addition to his Maryland credentials, he brings a little of Southern style to the table. He focused in his studies on finance, risk management, insurance, and he has been very, very successful in meeting the needs of clients in financial planning, as well as insurance benefits and small business strategies. So this team of two incredibly successful leaders and thought leaders and advisors to small business owners in the greater Maryland region is going to be our panel for today's program. So again, thank you all for joining. I want to point out a couple of things before we get started with the formal program. First of all, we are recording this webinar, and so for registrants, you'll receive a copy of the recording. In addition, we will be posting it to YouTube. And we will also be posting a blog article summary of the program. Finally, if you have questions that pop up that you want us to answer, there is a Q&A tool at the bottom of your screen, at the bottom of your Zoom screen that you can click on, and feel free to type any questions, and time permitting, we'll be happy to answer them. So with that, let's launch into our topic. So the Q4 Business Owners Playbook, trying to address the different priorities for budgeting, benefit planning, and business taxes. And one of the reasons we're here is these three are not unrelated topics. They are deeply interconnected topics. And in this very, very bizarre year, people are trying to figure out what they need to do differently, or are discovering the importance of things that they didn't do in the past that would be really important to do now, or to plan for next year. So let's open this conversation with probably the most emergent thing in most people's small business owners' minds, which is, what should I be thinking about in terms of minimizing my tax burden? And of course, that'll open us up to the wider discussion, since smart budgeting and smart benefit strategies done well often help reduce my tax burden. So we'll start with Matt, and then we'll open it up to Mike as well. What are some initial priorities, Matt, that you want every small business owner to be thinking about as we roll through Q4 here?
Sure. I appreciate you hosting this and moderating this, and I'm excited to be doing this with Mike. He and I have such complementary business models and mindsets that I always enjoy anytime we get to do this together. I would say the most important thing to first of all discuss is the fact that now is the time. We are in middle of October, actually, I guess getting towards the latter part of October, and now is the time to start talking about tax planning specifically. One thing that I've had conversations with clients over and over again is, that magic date of December 31st of, once we cross into 2021, our planning options become dramatically limited once we start looking in the rearview mirror. So now is certainly the time. And though there should be planning happening throughout the year, the planning does ramp up now because when it comes to projecting tax burden and tax liability, the more actual data that we have in the rearview mirror and the less projecting that we have going forward, the better. So typically, once we get through the month of October, and now we've got 10 months behind us, 2 months in front of us, becomes a really good time to start to pin down where we're going to be tax-wise. I would say, when it comes to tax planning, there are three probably main opportunities of tax planning, and a lot of it crosses over into Mike's world. One is, the one that a lot of people think about naturally, which is, is capital expenditures. What can I spend money on in order to save on taxes? Certainly a valid strategy plan. Though I will say, and one thing I always emphasize to people is that tax planning never trumps economics. Anytime you're thinking of spending money, that spend needs to make economic sense first before it becomes a tax strategy. Because when it comes to spending money, even in our highest tax bracket, you're only saving 30 cents on the dollar. So if you are thinking about buying a big piece of equipment, if you're going to be able to use that equipment to help generate revenue, save rental costs in the long run, absolutely, it makes sense. Let's pull the trigger on something that you could even finance it, and still get a big tax deduction. But if you just bought that piece of equipment last year and now you're thinking of replacing it just to get another, tax deduction, it's like, why are we going to spend $100,000 on a piece of equipment to save 37 grand if we didn't need that equipment in the first place? So, cash planning or those capital purchases. Then you have, if you're a cash basis taxpayer, you've got just traditional cash planning. Start to strategize what invoices that you're going to be sending out the door towards the end of the year to maybe start collecting some of your customer receipts early January instead of end of December, kind of kicking the can a little bit, prioritizing expenditures that are going to be happening anyway. Maybe you normally pay your insurance monthly, but this year, let's pay the annual premium up front, to be able to take that, tax deduction. There are certain things, and we can circle back. There are certain rules regarding what you can pay in full up front, and there are certain things that you can't from a tax standpoint. But I really wanted to kind of speak to probably one of your biggest bangs for your buck, which is really kind of leads into Mike, which is retirement planning. As I was already kind of speaking to, for the most part, the way tax minimization works is you got to spend $1 to save that 37 cents. Retirement planning kind of being the one exception to that rule, where what you're really doing is you're moving money from your front pocket into your back pocket and getting the same kind of tax break. Obviously there's, the catch is, you can't touch that back pocket for a little while. So it certainly still ties up cash, but it's still your money. Now there are a lot of various rules and regulations that govern that retirement planning, which is where kind of Mike comes in. So I don't know if he wants to speak a little bit towards year-end kind of retirement planning.
Mike, great segue. Thank you, Matt.
Yeah, thanks, Matt. You set that up perfectly for me. So like Matt was saying, there's a bunch of different ways to do retirement plans. Unfortunately, we were kind of talking about this prior. For 2020, we're kind of limited on what we can do from a safe harbor plan. We use the term safe harbor and non-safe harbor plan a lot. Just basically being safe harbor, meaning ways to get more money to the key owners. Anybody that owns 5% more of the company or is related to that person or makes over $130,000 a year are kind of limited to everybody else. So we've kind of missed a deadline for that, but that doesn't mean that you should feel discouraged or there's not, there's nothing you can do for this year.
Mike, can you just clarify that one more time for everyone here? Like the layman's explanation of safe harbor planning versus not safe harbor in a nutshell.
Yeah. So, and Matt kind of alluded to this too. In retirement planning, there's obviously ways to take advantage and to put away a lot of money and hopefully save a bunch of taxes. But what the IRS and Department of Labor doesn't want you doing is taking full advantage for yourself and then not taking care of your employees.
Ah,
So owners are treated in highly executive or highly compensated people are treated completely different than other employees. So another employee would be someone that doesn't own any of the company. Anybody that owns 5% or greater of the company is considered a highly compensated employee. And I have the exact figure here. A highly compensated employee is 130 for 2020. I just want to make sure, since we are being recorded, that I have the exact amount. So if you make over 130,000, you're a 5% owner. You're treated or greater, or you're related. So a lot of people forget, like, hey, I might have a son on the payroll, or a daughter, or a wife. They're considered highly compensated as well. So those people are
got
treated
it.
completely different from anyone else that is working at the company. All right, so that's the first designation. So
Thank you.
distinction. I'm sorry. So when we go into safe harbor planning, safe harbor just basically gets you around the entire 2% rule, we kind of say. So when you do retirement planning, if you put away, say when you do your review, you might fail and you get refunds, which I'm sure business owners have probably had if they have not had a safe harbor plan. You can do 2% more than the average of the non-highly compensated employees. So say that you have a bunch of zeros going on, you have 10 employees and a bunch of people are doing zero, one person's doing 2%. Well, the average might be 0.5, right? So the business owner or highly executive people can only do 1.5% of their salary. So you're not going to be able to put away and you can't save a lot of tax on that. So the way to get around that would be to use a safe harbor plan, and which we mentioned a little bit earlier. We're a little bit limited on what we can do for this year, but basically, we don't need to get into the details of it. But if you give 4%, you do a 4% match, or you give 3% to all of your employees, you get around that. It's 100% vested. It's a way to get around those testing, and you can be able to put away the full 19,500 plus 6,500 if you're over 50. So that I just took a huge course 400 and shoved it into 5 minutes of right there. If you have questions, offline, we'll be glad to dig into the weeds, kind of show you how exactly how we can do it. But that's kind of the overview of how we can break it down for retirement. So
yeah, go ahead, Matt. Mike, I'm sorry.
So with that being said, we're a little limited to what we can do for 2020 from a safe harbor standpoint. You can still do a 401k plan. You might not just be able to put away that full amount. That being said, employer money can always go into the plan, so we can use a variety of profit sharing ideas that you can get some money out of the company and allocate it to yourself as well as some of your employees. There's a variety of different ways that we can get around retirement planning, even though we're a little late in the year and we've missed a couple of the deadlines.
What do you tend to see in your work with clients, Mike, as the most underutilized aspect of retirement planning as a hedge against taxes?
The profit sharing piece, I would say, really, is a lot of employers don't take advantage of that. And when we're doing a profit sharing piece, it almost always makes sense. I shouldn't say always, but pretty much that you do a 3% non-elective where you're giving 3% to all your employees, whether they participate or not. Now you can put a year waiting period or however year being the maximum onto that, but it's a way to get, business owners up to 62,000, all said and done from all sources. If they're over 50 or 57,000, if they're under 50, and that's, majority of that's write-offs to the company. And Matt can obviously speak to a lot more of the tax implications of that, but that's a pretty powerful number. And just because you're putting away that for yourself, you're also putting some in for your employees. So it's a great way to retain employees. It's a great way to give them a little bit of a bonus, and you can put vesting schedules on that portion. So you might need to keep someone around for 6 years before they even get 100% of that, or, so if you have a lot of high employee turnover, it's a great way to strategize to give some of your mid-level management an additional employee benefit. But the profit sharing piece is a very underutilized portion of retirement planning, I think. And I think the problem is there's a lot of confusion with it. And if you don't have the right administrator piece, who can actually run the illustrations, work with your accountant, and then obviously us as well to make sure it all kind of flows together, usually is a good point to start.
Matt, what are your thoughts on profit sharing and its tax implications, as well as just your overall sense of where it fits in the equation for small business owners?
Yeah, I agree with Mike. It is probably a somewhat underutilized aspect of retirement planning. Often, because it can be a little intimidating from a cash standpoint when we start talking about maxing these things out. But I think sometimes what gets misunderstood is it's not a necessarily an all or nothing proposition that you either have to, put away nothing or max out at 62,000 plus plus money to the employees, which can be intimidated. That you can do any range in between. The profit sharing is a very business specific calculation. There are actuarial calculations that are done. But I will give just kind of a generic example that seems to illustrate the point. So depending on the number of employees, it's not that unusual for the owner to be able to put in their 19,500 and then put a profit sharing on top to get them that total 62,000. And depending on the age and number of employees, but let's just, for example purposes, say they end up having to put in $18,000 for on behalf of their employees, which is another thing that I think sometimes trips up some owners. It's just like, man, that's a lot of money to be given to my employees. But when you think about it, your 62 plus that 18, was 80 grand that we were able to put away. That $80,000 is saving me about $25,000 in taxes. So yeah, it costs me 18 to my employees, but it saved me 25. So would I rather give my money to the IRS or to my employees? So because you're going to give it one to the other. So I've kind of, to me, it, when it's really laid out, if you have the cash, it's almost a no-brainer. You just were able to put, $62,000 away for yourself, and saved you $25,000 in taxes. So you're still about, $7,000 to the good after you've paid your employees what went into their plan. Why not do it? So again, if the cash flow is there to justify it, because that 62,000, that the one catch is, that's kind of untouchable money for a while. So you lose the use of it, within the business. But if you have the excess cash flow to be able to do it, I think it makes complete sense.
Do you find that this is something that's a good fit for certain kinds of businesses, or do you feel that it can be equally applicable across the board? So just as an example, if I have a medical practice or if I have a retail or restaurant business where I have, some employees who've been with me a long time, but then I have, a workforce that naturally turns over as opposed to a professional firm. What is your take? Or do you feel that properly calculated and properly applied, this is a tool that every business owner should consider seriously?
So I'm going to let Mike correct anything that I'm saying incorrectly right now.
Yeah, I'm here.
So it's certainly not a any kind of industry specific thing that certainly applies across the board. Where it does show its most power, though, is where there's a fairly healthy disparity between what the owner makes and what the employees make. So if you have several employees, maybe a lot of sales staff that with commissions have big W-2s that rival the owner's W-2, then the math doesn't work quite as good, because now the money you have to give your employees does start getting fairly big. But if you have a fairly, healthy disparity where the owner clearly has the largest, pay, and, and the employees who, I'm assuming, all people that I work with, and I'm sure say with Mike, everyone treats their employees great. So everyone's competitively compensated. That being said, if there's a nice disparity between, the owners and, and the employees, that's when the math gets really powerful. The other thing, if you happen to have two spouses that are both actively engaged in the business, then the numbers can get very powerful, because now you have, two owners that are both making a lot of money, that now it's $62,000 times two. So that can get where it can get really, for lack of a better term, sexy.
So they're both individually recognized in the calculation as individuals, not collectively in that regard.
Correct.
To your point. Okay.
As long as I'm not saying anything incorrect. Mike will jump in and give me a big X.
I mean, the only thing I would say too, Matt, is a very big factor is age as well. So if you have older owners and younger staff, it's a dream for everybody. Because if I give my, let's take Matt because he's a little bit older than me, so we'll pick on him for being older. If we give Matt $1, you might only have to give myself 30 cents because of the time value of money. And that's a very big factor into these calculations that all the actuaries run to see how to pass the IRS test. So
clarify that distinction one more time, because workforce age is a huge factor for virtually every small business owner today.
Yeah, so it's all based on normal retirement age, right? So if I'm 60 years old, I might be able to take 10,000 and only give my 25-year-old employee maybe 1,000. It's the numbers don't hold me to these numbers, but
I see,
because I have a lot more time for that $1,000 to grow versus the 65-year-old business owner that has $10,000 now. You're just trying to fund that retirement benefit age now, and that's the calculations that they factor into it.
I gotcha. Okay, right. So it recognizes the disparity in the time frame available for that money to accumulate value over time and be a significant contributor to the ultimate retirement of the individual.
Yeah, and I think one thing we do see as well, Doug, is there's an older owner and then a younger owner maybe that's starting to buy out the company, or might be, and the calculations can get thrown off by that younger employee. One thing that we've seen to make, that might, especially if it's a 50-50 owner, well, they're saying, hey, well, how come, the older owner is getting this amount of money? How do we compensate the younger employee? Or the younger owner, you can always take a draw, and Matt, this is where Matt's key in making this decision as well. You're not going to get the same tax write-off, but at least you can take a draw, maybe put it in an investment account. They're both invested, so at least you're kind of getting a fair share of a younger, older employee. We have done situations like that prior, because the tax savings was enough to make it sense for the whole company, but to be able to true up that other younger employee, that's a way around that.
So in this no, I'm sorry, go ahead, Matt.
I was going to say, Doug, the one thing I was going to, add is, what we're talking about is the profit sharing component of a 401k plan. This is not, speaking to and preventing, if you have a safe harbor plan of the owner still putting in the $19,500 of their own money plus an extra $6,500 if they're over 50. Just because the math on a profit sharing may not make sense, you could still have that provision built into the plan. It can be a year by year, calculation to say, hey, does it make sense to do it? And maybe as your demographic changes over time, it may make sense. And, and anybody you're working with, Mike specifically, they'll absolutely run those numbers for you. So, it doesn't have to, scare a business away from implementing a 401k plan, even with the profit sharing option and component to it. It's not like the old defined benefit plan days where you are ahead of time, committing to some sort of level of annual funding that you're worried that you're not going to, have the cash to do.
So profit share, if it's built into your 401k plan, is not a fixed commitment. You can choose each year whether to engage that mechanism or not.
Correct. Yeah. I mean, the only thing you're really committing to is if you're doing some kind of match. But if you're doing a discretionary match, you can always discontinue that or add that at any time throughout the year. Again, I'm going to refer to that safe harbor match or safe harbor contribution. You're locked into that for a year, and you make that decision generally for a start. If you want to get it for this year by 10/1, but for next year, there's still time. If you have a 401k plan, you can make that decision now to go safe harbor for next year. Or if you're looking to start up a plan, you can start up a plan at any time next year and be able to implement a safe harbor. And that again allows you to really take advantage of putting away the full amount if you're an owner or a highly compensated person.
So this brings us to a separate but related topic, which is open enrollment, which is health insurance and benefit strategy. Like, I have to take a deep breath myself, just thinking about this as a small business owner. What should we be thinking about? What should we be prepared for? I know we got our renewal letter, and I tried to bury it under a rock for at least a week so I could calm down. What are your thoughts, gentlemen, and what are you seeing with your clients, and what are your recommendations around managing the cost of benefits and making smart decisions?
Well, I wish, Doug, you would have asked that question in about a month after the election. That would probably give us a little bit more leeway where we're going to be going. But
Wait, there's an election coming up? What are you talking about?
so in internal discussions, and I'm sorry to step right on this, Matt, but this is kind of what we were living every day. So in internal discussions with our staff, any of our clients out there know we have a highly skilled non-practicing CPA named Patrick Harvey on our team that handles our health insurance division, constantly trying to figure out what's going on, constantly keeping clients up with changes coming along the pike. So we think no matter who, whether Donald Trump is reelected or Joe Biden wins the election, there's going to be changes to health insurance. What that is, I don't have a crystal ball. I don't know. And obviously it has to get through the House and Senate as well. But any benefits broker should be on top of this and, have something coming out to you within the next, month or two of what they're expecting. We think that there's going to be changes. The one thing that we think is going to be here to stay is high deductible plans. So, and this will tie right into Matt too, and I'll let him take it from here. But high deductible plans allow you to establish HSA savings accounts, which is a great way to write off taxes as well. It's, highly compensated people are losing kind of a lot of their write-offs. So here's another direct write-off of their taxes. It's a way to save $7,100 if you're in a family plan, or $3,550 if you're in an individual plan. We think that those limits are going to continue to go up. It's not like the old FSA days where you use it or lose it. You can build this up. You never have to use it at all, really, and you can save it for retirement. And then most providers out there will allow you to invest it like a retirement plan. So you can put it into a target date fund or anything that you might need to let it grow for retirement, because the average health cost in retirement, they're saying now, the studies say, around $250,000. So that's when your retirement age is 65. Yeah, you're going to live for another probably 20 years, the statistics say. So being able to plan for that in retirement is a huge thing as well.
Hold on, you were saying that the average person will need $250,000 for what?
Because everybody thinks that,
for what?
For
healthcare.
Healthcare alone. That's the one line item.
65, right? You start your Medicare, but that doesn't include all the supplementary products you want to buy to pay for your prescriptions and
right.
Get hospitalization. But there's a bunch of different supplements you need to buy that can add up, and then obviously long-term care costs on top of medical costs. Right. So no one ever tells us, man, we screwed up, we saved too much money for retirement. It doesn't happen. So these are just ways to take advantage of it now, especially while the company's profitable.
So why were HSAs kind of a hot item, maybe 10 years ago? And at least my impression is they sort of cooled off. Now, I think a lot of business owners don't even realize they're still on deck, probably because post ACA, people were working in other but the reality is they haven't gone anywhere, and they have huge upside benefits. Matt, help us untangle this spaghetti of confusion around high deductible plans and where they fit in the health insurance puzzle.
Well, like Mike spoke to, the big misnomer about, HSA is they get confused with the older type of plan where you used to have this use it or lose it provision to it. So it used to be, it felt like a very risky calculation of how much am I going to fund, into this thing? How much am I going to need? Because if I end up not, using it at the end of the year, it just goes away. Now you can feel perfectly good about, maxing the thing out as long as you've got the cash to do it, because it stays there forever. And like Mike spoke to, depending on the provider, within that vehicle, you can even, invest that money, long term. I still have 4 school-age children at home. So I max out my HSA and use every dollar of it because I got plenty of healthcare costs. But, but for those who have a year that, that just, was a nice, healthy year, and that's fantastic, and they weren't dealing with, braces and, all the other things that come along. that
This is spoken
uh,
from hard-earned experience, clearly.
right, that can start to build up over time. The other and the reason I think they're exploding in popularity again is because those healthcare premiums are just going up and up and up. So using a high deductible plan is one way to somewhat, as best as you can, control those costs.
Mhm.
Which, from a planning standpoint, it kind of brings me to something else I want to bring up, especially for my younger and newer businesses that might be tuning in, that maybe don't offer health insurance yet, but are in the process saying, hey, in order to recruit and retain talent, this is really something we need to be offering out there. From a planning standpoint, you do need to think through, in consultation with your CPA, consultation with your insurance provider, of what is going to be the benefit, not only with how the plan is going to be designed. Are you going to go with a high deductible plan with an HSA offering, but in addition to the plan, how much are we as the business going to pay for towards that? There are, again, rules that govern how we treat our employees, and in the consistent manner in which we treat our employees. And I have seen young, newer startup companies that offer health insurance for the first time decide they're going to pay 100% of it because there's 3 people on the payroll, and they're all key people, and that doesn't seem cost prohibitive. But you have to really think through, like, all right, are we always going to be 3 people, or is our goal to grow this thing? And if we establish a benefit that we're paying 100% of everyone's health insurance, and also that 3 people becomes 20, that starts getting very expensive very quickly. And there are some rules that govern how easy it is to discriminate against other employees. Say, hey, well, we're not going to pay for these employees, or you have to roll back that benefit to everybody, which has its own issues from a PR standpoint of telling your employee that, hey, I know for the last 3 years we've been paying for all of your health insurance, but we can't do that any longer. So even in the implementation phase, it's good to be thinking through with a longer term, broader vision in mind of where do we like to want to see this company go, and what do we see is going to be the long-term benefit we're willing to offer our employees.
Let me actually throw a question on deck that I think you're keying into, because I know in our own experience, we used to have a high deductible HSA plan. Then in our small business, we switched to the HMO model, which is only available in certain parts of the country. In our case, Kaiser Permanente. But the reality is that in my experience interviewing people and working with younger employees, they don't understand. There's so much like how does a small business demonstrate, without creating a flow chart and a mathematics course, to younger talent or less experienced talent that a high deductible HSA option is as good or better than what they may potentially be offered by a company that has taken the more traditional route?
Yeah, absolutely, Doug. I mean, the younger employee that's hardly going to the doctor is the perfect example of someone that probably should be in an HSA plan. So,
Right.
so when we look at it, right? So say you're on a fully insured plan where you're just paying your co-pays here and there.
Mm-hmm.
Well, that might cost, an extra $200 a month to be on. Why would you pay that extra $200 a month if you're not going to the doctor, when you can just put it in your HSA? And then if you don't use it, you don't lose it, and it just keeps building up and up for you. You're saving that money. Keep the money in your pocket rather than give it to the insurance company is the first thing I would say.
Mm-hmm. Oh, that's
To
a
answer
good
your
point.
second question, surround yourself with a good benefits team that will come out and sit down with your employees, that will give them your cell phone number. I mean, I challenge anyone to all the time, ask your broker, your advisor, if they'll give out their cell phone number to your employees. Majority would say no. We strongly encourage that. We do that. We want to help the business owners offload all that work to our team, so that if your employees have questions, we can help walk them through it. Now, we always want things to go through HR, just so HRs kind of know what's going on as well. But we'll come out, we'll sit down one-on-one with an employee and talk about health savings accounts. We can do it as a group presentation, and a variety of benefits, any kind of benefits. That's something that we pride ourselves on, being accessible to any employee, no matter how much or how little they're making. We look at the group as a whole, not as one person.
Mm. So
Even
is
just
it, yeah, go ahead,
I
Matt.
was going to
No.
say, to add on to that, the other thing that I always suggest to businesses, as they're recruiting and hiring talent, especially younger talent that may be experiencing some of this for the first time, is make sure in your your offer letter, your compensation package, that you're monetizing these benefits. Help them to see the dollar value of what it is that they're getting. And we didn't even touch on, there are so many additional employee benefits that can be offered that are actually relatively inexpensive to the employer, when it comes to disability insurance and other things of that nature, that can really build up, and you can lay out on paper and really paint an attractive picture for an employee. Even things like teleworking, which thanks to COVID is becoming somewhat of the norm. And I think especially with this younger generation, I don't think it's going anywhere, and a lot of people are going to want some aspect of that. There's ways that you can realistically even monetize in an offer letter of the dollar value of that of that benefit as well. And in a competitive marketplace, making your overall compensation package, I don't want to say seem as if it's a sham, but being able to really just show them how attractive your offer really is.
So what would you put in that list of benefits that, when properly organized, can help create a very rich package for prospective employees or current employees in a small company?
So, and Mike, certainly brainstorm me if there's anything that that I'm not thinking of. But obviously, your base pay. I would even throw in things like workers' comp insurance, certainly any kind of 401k match, anything that you're putting towards their health premiums. Group term life insurance is a very inexpensive benefit that at a business scale can be provided for people very inexpensively. Again, you start talking about cost to teleworking, monetize their commute and the gas money they're going to be saving. I mean, you can get somewhat creative, and yet it's still being a real picture of these are all benefits to to working for your firm or business.
Mike, things to add? I'm literally taking notes. Like, this is a great, one thing that I'm realizing as a small business owner, and I'm sure others are as well, is we honestly don't do a very good job of presenting the strength of what we are investing in for our employees. We're so busy running our companies that we haven't even necessarily taken the time to say, well, just exactly what all are we doing for our team? And if we can't communicate it, they don't know about it, even if we're doing it for them.
Yeah, and Doug, you might be able to correct me if I'm wrong, but I believe what we presented on a benefits plan webinar that maybe is on the website that people could refer back.
Yes, absolutely.
But I mean, the majority of where it starts with benefit planning, obviously Matt brought up some wage pay and stuff like that. I'll just focus on the benefits aspect of it. It typically always starts with health, dental, and vision, or retirement plans. That's pretty much the first two areas we see where we come in and start helping employees. Once those two, the two big ones really get established, then we start looking at kind of the ancillary benefits. So your group life, short-term and long-term disability. So short-term, especially if you have a younger female-based pregnancy leave, that's a great way to give a great benefit to someone, to a female that might be going out on maternity leave, to be able to get 60% of their pay. And then heaven forbid, we never hope that someone collects on long-term disability, but that would pay you to your Social Security normal retirement age. That's a great benefit too. If they were hurt and heaven forbid a car accident or something, but they can't work anymore, it's a way to at least get 60% of their income, monthly income, up to their retirement age. And then, like Matt said, group term life is super inexpensive. You could give $25,000 to your employees, and it might cost you 30 employees, maybe $200 a month. And again, don't hold me to numbers, but it's really inexpensive, great benefits. These are all employer paid. Once you kind of get that whole package together, then we start seeing voluntary products where employees actually pay for it. But it's a great way to get discounted pricing for extra life insurance, critical illness, accident insurance, man,
Well,
even identity theft. We're starting to see as a group voluntary product out there. Head insurance. I mean, there's all kinds of different benefits that you can bring to the table that you can withhold the employee's payroll, and it's just great.
mhm. Like preventive, like health club membership program, anything like that as well to help
That's
encourage healthy
typically done.
lifestyles.
Yeah, it's typically done through a payroll company since there's not really any insurance companies out there that provide that benefit. But
Got
yeah,
it.
definitely ask your payroll companies or kind of have an internal policy of, hey, we'll reimburse $50 a month if you're going to the gym and you need to prove it or whatever it might be. So
I got to talk to my boss. I need to ask for some of these benefits. All right, I am the boss. That was a great list, and in the follow-up blog article, we'll make sure to list each of these things. I think that was spectacular, Mike, and the way that you organize them into the different categories. So let's pull a couple of these pieces together. We've been talking about tax planning. We've been talking about managing cash. We've been talking about employee benefits and retirement. This is a year of unprecedented bizarreness, for the lack of a better word. A high percentage of small business owners have at least received some form of federal financial relief, primarily through the PPP program, some through EIDL, and then other programs, state, local, some county programs. What should people be doing, thinking differently about, to try to manage how their entire financial environment is something that they hadn't envisioned when they started this year? What are some key points that are specific to our COVID universe?
I'll jump in about a few of the things that you mentioned. So first of all, the PPP.
Yes.
We are right in that time period now where everyone's starting to kind of hotly talking about the forgiveness side of the PPP. Everyone got their PPP money. They've used their PPP money, and now it's time to get that debt forgiven.
Right.
This is the one area that I am advising businesses to not be an early innovator on the PPP forgiveness. There is no rush to this. The deadline for forgiveness is 10 months after your 6-month covered period. So for example, Brady Renner, we got our PPP funded, late April. So let's call it, May 1. So our, 6-month period, is November 1, right? If I'm doing my math correctly. 10 months after that is September 1 of next year is when my forgiveness application is due. There's no reason to rush on this. And, the SBA continues to come out with further guidance, and really without exception, and I'm trying to think if there's even an example, and I don't think there is one, without exception, every time the SBA has further clarified something, it has been in the small businesses' favor. They're making this easier and easier, and I think it's going to continue to get easier and easier. So let's let it get easier and easier. Why rush on this? They just pronounced last week that now if your PPP loan was under $50,000, you basically have to do this one-page application and provide no documentation. There's a rumor that they may expand the size of that to larger. So let's wait and see. The other aspect to that is there is still debate as to whether you're going to have to pay tax on this money. That's the big question mark. We all know it's going to be forgiven. You're not going to have to pay it back, but you're going to have to call it income for tax purposes. And there's, the way this played out is when the CARES Act was passed and the PPP was created, it was created for it to be a forgiven loan, and that forgiveness was going to be excluded from income. Therefore, you don't pay tax on it. Unfortunately, the IRS came right afterwards and put out a revenue procedure basically saying, though the PPP forgiveness is excluded from income, any expenses that you incur that you use that money for, i.e. your payroll, because that's what it was there for, can't be tax deducted. In effect, making it taxable. Now, several congressman came out and said, wait a second, that was never the intention. You know, you were never supposed to pay tax on this money. We are going to fix this. Now, you know, Congress in their infinite wisdom has yet to do anything to actually fix it. So as it stands now, you are in effect going to pay tax on this money. If I'm a betting man, I still, for my opinion, I'm going to call it 70-30, most likely that you're not going to pay tax on this money. However, even if you had to pay tax on it, that money becomes income once the debt is forgiven. So that's another motivation of don't have it forgiven in 2020, you know, because even if it, you know, ends up becoming a tax issue, let it be next year's tax issue. So that's just another reason to not rush to forgiveness right now. You know, and people are starting to get a little nervous about it because they're starting to get communication from their bank about we're about to be ready to accept forgiveness applications. Just because they're ready doesn't mean you're bumping up into any kind of deadline. There really is no major rush to this. So that's, you know, one of my, you know, big advice regarding the PPP.
And do you think people are responding like that because during the application period, it was like, get it in now, get it in now. And so we're sort of conditioned to treat this as a frenetic response?
Correct, absolutely. Because again, there's been many clarifications along the way, but when the law was first passed, your first payment, and therefore you wanted to get forgiveness done prior to that first payment, was going to be due 6 months after you've received the money. And we're getting close to that. And a lot of people don't realize that that deadline has changed. It's no longer 6 months. It's now 10 months after 6 months. Like it went from 6 months to 16 months. We no longer have a rush on this. And maybe there are a lot of people that don't realize that that deadline has, you know, has moved. I actually just got an email from a client today who said, you know, I was hoping you can help with the, you know, PPP application. Our first payment is due November 20th. And I'm responding like, no, it's not. You know, it may have been that at one point, but it's not due November 20th. It's due September 20th of next year. You know, so I think that's, you know, why a lot of people are, you know, somewhat amped up about it because, you know, they're not realizing, you know, some of the changes that have happened. The other thing, and I'm going to kind of pass this to Mike because he may know a little bit more about this other than me knowing that exists, is one of the other provision of the CARES Act, speaking of this COVID specific world, is people that are over 70 or what's now 72 that are required to take a minimum distribution from their qualified plans or IRA accounts. There's a provision in the CARES Act that basically is allowing you to forego your minimum distribution this year. And a lot of people, you know, wait until the end of the year, you know, to do that. So haven't taken the minimum distribution this year. And again, this should be done in consultation with your financial advisor and your tax advisor, you know, but this could be a good year if you don't need the money right now to allow it to stay in the plan and just skip your RMD this year. And Mike, I don't know if there's any other pieces to that.
No, you hit the nail on the head, man. I mean, you hit all the rules. But the funny thing is a lot of our clients are just so used to the money now that they're just like, we'll keep taking it, no worries. So, but yeah, you're absolutely right that you don't need to take an RMD this year if you don't want to. So,
and
one other
thing that occurs to me, and as this is just how goofy 2020 has been, is that for, you know, all the financial crisis that's out there, and there is a lot of it, because of some people's unique industry and business model, and because of some of the government help, there are some people that are actually finding themselves sitting on more cash than they've actually ever had in the history of their business, whether it's from borrowing the EIDL money because of the PPP. Again, maybe they are in one of those, you know, industries that, you know, has actually, you know, done quite well. You know, quick example, you know, everyone talks about how devastated the restaurant industry has been, and they have been, and it's, you know, terrible to see all these restaurants closing the doors. But there are a few people niche within the industry. I have a few pizza shop owners that are killing it because everyone's ordering pizza now. Because everyone's home. And so there are some industries that are actually doing quite well, and some businesses doing quite well. So they are sitting on, a lot of cash, and people are kind of wondering, what do we do? I've never had so much money in my business bank account. My first inclination is, I am recommending people stay liquid. We still have many, many unknowns of what's going on. Who knows what's going to happen as a result of the aftermath of the election? Who knows where this COVID stuff is really going? How long is this going to continue, status quo? And even if things continue to start to open up, how long it's going to take? I don't buy people's comments of we're doing fine, I don't need the money, because my response is you don't know that, because we don't know where the world is going. So I want people to stay liquid, but that doesn't necessarily mean keep $400,000 in your business operating account. There are some things that you can do, and I'll turn it over to Mike in a second, of things that you could do with some with some cash right now.
Mike,
Yeah.
what do I do with the 400,000 that I have sitting in my business operating account?
The first question there,
I wish.
the first thing we talk about is time horizons. So, when do you need the money is always going to be the first question a good financial planner or a good financial advisor should ask you, because that's going to make a lot of determination on what we should do. Obviously,
Yes.
keep what you need in the business to run the business. That is first and foremost. Don't put yourself in a financial potential struggle. But if you're a pass-through entity, and Matt, thanks for correcting me earlier on that part. If you're a pass-through entity, you're going to be paying tax on that money that's sitting in your account anyways, right? So why not get it out, put it into a personal account? That way, at least it has somewhat protection from creditors. It's not in the corporation's name. That's the first thing. Now, they're probably going to still probably come after you, but at least it's not in the corporation's name. And we can invest that as aggressive or as conservative as you want to. You could go and just have it in money market type, very liquid investments, and just try to earn a little bit more than what the bank would give you, which is virtually nothing right now. Or if you don't need the money for whatever it might be, you can get as aggressive as you want. And you can always loan it back to the company and charge interest to the company as well down the road. And I'll let Matt talk more of that, but you can always loan it back to the company if the company needs the money. But it's a good personal play for yourself. And then the one complaint that we hear a lot of times is, Mike, I would love to do that. That sounds like a great idea, but my bonding company needs it in the corporation's name. Well, great. We can open up a corporate account and we can invest it and put it in, again, liquid money market type investments or structured CDs or whatever it might be, so that we hit those time horizons. But there's a variety of ways that you can do to utilize excess cash and not be kind of stuck at a bank making virtually nothing on your money.
Yeah. So, and just to kind of put a bow on that, back to my original point of staying liquid, and Mike spoke to it, is there are ways that that you can put your money to work for you and still be fairly liquid. It doesn't necessarily have to tied up long term, but still making more than zero. But the biggest thing that that I'm advising people is just one of the most common things I'm hearing, whether it's because of the PPP money, whether it's the EIDL money, whether it's just to improve operations, that some people may be sitting on other business debt that they've had over the years, and it's like, now I have all this cash, I'm paying interest on these loans, why not pay down those loans? And my advice to them is, that is a great idea, just don't do it yet. I still am advising people of, let's let the world continue to play out a little bit. This is just my humble opinion, I think it's worth paying a few more months of interest on loans to make sure that I still have that money available to me, if we are to need it, depending on where this goes. If we get through the, we'll continue to evaluate, if we get through the end of the first quarter and, the world does feel like it's continuing to turn and my business is starting to feel stable, then by all means, take some of this money, pay down debt, get rid of some, maybe some higher interest loans. I just, once you've paid off a loan, you can't necessarily get that money back again. And now, and now maybe you're cash strapped.
Right.
So I just, it sometimes may feel like a cop out, but when it comes to cash right now, I'm advising the wait and see game.
So to your point, the credit environment is all confused and upside down and backwards as well. So it is entirely possible that, a small business pays off loans and then will not be able to be approved for the same amount, 3 months, 6 months later when they realize they need it again for a different,
Correct.
or the same purpose.
Right.
Yep.
So closing thoughts on upcoming deadlines. What are some key deadlines that we should be aware of?
So I already spoke a little bit earlier of the 12/31 deadline, which is just, a lot of tax planning. Once we cross into that new year, there's nothing that could be done. Now, we spoke a lot about the profit sharing side of retirement plans. That's actually one of those few exceptions that those decisions can be made after the fact, and that money can be funded up until you file your tax return. So that's another kind of cool aspect of those kind of retirement contributions. The other one that sneaks up on people quicker than you think is the July 31st deadline, which is your deadline for filing W-2s and for issuing 1099s. And if you have a lot of employees, if you issue a lot of 1099s, my advice is, and for the sake of your CPA that might help you with this, is let's not wait till January 20th to start thinking about that kind of stuff. Let's do what we need to do going through the month of December, that once we crest over into January 1, those things can get knocked out.
And what is that date again? That last deadline?
January 31st is when those are due.
Got it. You're right. So the new year
fourth quarter
brings
estimate.
some news. Yep.
Fourth quarter estimate is due January 15th. Yeah, those are the and anything.
That's a good list.
Again, speaking to that 12/31 deadline, anything that is related to your payroll, that 12/31 deadline exists. So even though the profit sharing component can be funded after the fact, that $19,500 that we talked about that you're actually having withheld from your paycheck, that's got to be done during the calendar year and included on your W-2. So that's got that 12/31 deadline.
Wow. Awesome. Thank you. Boy, we covered a lot of ground. This has been an extremely informative webinar. And I think it really made me realize as a business owner how tightly these pieces tied together. Instead of viewing these as separate things on my own list, tax planning, employee benefits, cash planning, financing, growth, now I'm starting to see them in a different way. I recognize that they are all really part of one strategy. And for me, one of the things that means is having a team like the two of you working together to help business owner clients is utterly critical. Utterly critical. You've got to have a team working for you. And Brady Renner CPAs and Kelly Companies sure as heck are a spectacular example of that. So my thanks to you both for bringing enormous insight and a good sense of humor to a very complex and wide-ranging discussion. Our thanks to all of you who joined us in today's webinar as attendees and participants. And as I said, everyone involved will receive a follow-up with the recording, and we look forward to holding more of these programs in the near future. And we hope in the near future to also get together in person again as well. So my thanks to everyone, and we appreciate your time. Have a great day.